As every manager and business owner knows, a company has limited resources to fund capital investments, long-term investments in assets such as manufacturing equipment, office equipment, buildings, and so on. Therefore, a company must analyze capital investments by using a set of simple mathematical equations. Managers and executives regularly use these equations to help guide their investment decisions. In the sections that follow, we present the Investment Analyst Toolbox, equipped with equations. Proper application of the tools shows which investment options offer the best returns to your organization and to its investors. Net Present Value, NPV. Net Present Value, NPV, is the anticipated profitability of a particular investment, considering projected cash flows discounted by a risk factor that takes into account inflation, level of risk, and returns required. In simpler terms, you compare a dollar invested today to projected dollars generated from the investment at some point in the future, the time value of the money. By calculating NPV, you can determine whether your company should pursue a particular investment in capital equipment or other assets. Internal rate of return, IRR, is another approach to determining whether the return of a particular investment makes it worthwhile to pursue. IRR is simply the rate of return that the investment produces or the reward for making the investment. IRR is related to the NPV in that it represents the discount rate in which the NPV of a cash flow stream, inflows and outflows, equals 0. In fact, IRR and NPV are two sides of the same coin. With NPV, you discount a future stream of cash flows by your minimum desired rate of return. With IRR, you actually compute your break-even rate of return. Therefore, you use a discount rate above which you'd have a negative NPV and a poor investment, and below which you'd have a positive NPV and a great investment, all things being equal. IRR often is used to compare a potential investment against current rates of return in the securities market. When calculating IRR, you make the present value of an investment's cash flow equal to the cost of the project. The result is an interest rate, say 5%, that you can then compare to the interest rates of other investments. Payback period. The payback period equation gives you a way to calculate how long it will take to earn back the money from a particular investment. You calculate payback period by using the following formula. Payback period equals investment divided by annual cash inflow. The lower the number indicating a faster payback period, the better, because the investment will become profitable sooner. Profitability Index. Profitability Index, also known as the benefit-cost ratio, gives you a way to evaluate different investment proposals that have determined net present values. You calculate Profitability Index by using the following formula. Profitability Index equals present value of future cash flows, NPV, divided by initial investment.